Introduction to ESG-labelled debt securities. Environmental, social, and governance debt securities are bonds issued to finance projects that bring positive environmental, social, or governance outcomes. These securities have gained popularity in global financial markets as investors seek sustainable investment opportunities. Under Chapter 10 of the IFSCA Listing Regulations 2024, issuers can label their debt securities as green, social, sustainable, or sustainability linked provided that they meet specific criteria and align with internationally recognized ESG standards. Applicability of Chapter 10. This chapter applies to all ESG-labelled debt securities, including green, social, sustainability, and sustainability-linked bonds, as well as any other ESG-labelled securities specified by the IFSCA. These requirements are in addition to the regulations outlined in Chapter 9, which covers the listing of debt securities in general. Each type of bond has a distinct purpose. Green bonds finance environmentally sustainable projects. Social bonds fund social development initiatives. Sustainability bonds combine both environmental and social projects. Sustainability-linked bonds are tied to specific sustainability performance targets. Recognized standards for ESG-labelled debt securities. For a debt security to be labelled as a green, social, or sustainability, the funds raised must be aligned with one of several internationally recognized standards. These standards include the following: International Capital Market Association Principles and Guidelines, Climate Bonds Standard, Asian Standards, European Union Standards, any framework or methodology specified by a competent authority in India, or other international standards permitted by the IFSCA on a case-by-case basis. If the security is labelled as sustainability linked, it must align with the same recognized standards or any additional qualifying criteria set by the IFSCA. Role of the independent external reviewer. An important requirement for ESG-labelled debt securities is the appointment of an independent external reviewer. This reviewer is tasked with ensuring that the security is aligned with one of the recognized ESG standards. The independent reviewer must be independent of the issuer, its director, and key managerial personnel, be compensated in a way that avoids conflict of interest, and possesses expertise in assessing ESG debt securities. The external reviewer can provide one or more of the following types of assessments: second party opinion, verification, certification, or scoring rating. A credit rating agency or ESG rating provider registered with the IFSCA or another recognized regulator may also act as the external reviewer. Additional disclosures for ESG-labelled debt securities. When issuing ESG-labelled debt securities, the issuer must make additional disclosures in the offer document or information memorandum. For green, social, or sustainability bonds, the issuer must include the following in the offer document: a statement on the ESG objectives of the debt issuance, details of the evaluation and selection process for the project or assets being financed, proposed use of proceeds with the detailed description of the project and assets, systems and procedures for tracking the deployment of the proceeds. For sustainability-linked bonds, the issuer must additionally disclose the rationale for issuing sustainability-linked debt, how the issuance aligns with the issuer's overall sustainability and business strategies, details on pre- and post-issuance obligations, including key performance indicators and sustainability performance targets in line with recognized standards such as the ICMA Sustainability-Linked Bond Principles. These components include selection of key performance indicators, calibration of sustainability performance targets, bond characteristics, reporting, and verification. Continuous disclosure requirements. After the issuance of ESG-labelled debt securities, issuers must meet continuous disclosure requirements to maintain transparency. These disclosures must be provided to the recognized stock exchange at least annually. For green, social, or sustainability bonds, the issuer must disclose the utilization of proceeds, a list of projects or assets funded by the issuance, including brief descriptions and amounts disbursed. Impact assessments, including both qualitative and quantitative performance indicators. Where quantitative benefits cannot be measured, the issuer must explain why the benefits were not ascertainable. For sustainability-linked bonds, the issuer must provide additional disclosure, updated performance information on the key performance indicators, any data that enables investors to monitor the sustainability performance targets, and a verification report from an external reviewer outlining performance against the SPTs and their impact on the financial or structural characteristics of the bonds. These continuous obligations ensure that ESG-labelled bonds remain aligned with their stated objectives, providing investors with regular updates on the social, environmental, or governance impacts of their investments.